The second type of trade location is where we open outside of value but still in the previous day's range. Again, looking at the example, we're now opening outside of that orange area or outside of the previous day's accepted value area. Now again, remember what we said was when the market opens outside, it's not as balanced, but it's still relatively imbalanced so long as the previous day's extremes remain intact. It's when those extremes get taken out that we then start to see a little bit more volatility in the market. Now, note, due to this opening out of balance, there's a higher risk, but a higher opportunity for trades. Then the extension of the previous day's extreme will bring a much higher sort of a bias towards outside value. So what we're trying to say here is that when the market opens outside of value and breaks out of the previous day's range, there's a high probability that on that day type we are going to accept value outside of the previous day's value area. So again, it's not to say that we're going to open and initiate or trend higher, but there's a high likelihood that when the market shuts on that second day, the value area will be a lot higher than the previous day's value area. And you can see this in the example where the orange area being the first day's value area. Once the second day finally finished, we can see how we have a much higher value area than the first day type. Then note again, when we do have these open out of values but in range, we do lean on the previous day's extreme quite a lot as a potential reference point. And then last but not least, what we're going to move to is our opening out of the value area and opening out of range.